Welcome back to my YouTube channel, Victory Reverse Mortgage. I'm Benny Victory. This is the third part of a video series that I started yesterday and did another video this morning. Collectively, these three videos are dealing with the concept of how you determine a reverse mortgage loan amount and what you're used to with your traditional forward mortgage. And that's what we talked about yesterday, was the relevant factors that go into a reverse mortgage. In the morning video, what I did is I broke down and went into a little bit more of a detail with what a traditional forward mortgage that you're used to goes to, and its components and its criteria. Now, in this video, what we're going to do is we're going to bring both sides together and look at the considerations and the relevant information that I want you to determine whether it's suitable for your retirement path. The most important thing that you could do in terms of making this valuable for you, this video valuable, and the information that I'm giving you be relevant to you, is participate and take these numbers that we talk about when I flip this and share the numbers and apply it to you and really determine if the path that you're on is going to be the right path. And in this scenario, what we're going to do after I go over the other side, we're going to come back and you're going to see the reverse mortgage final picture and the traditional mortgage final picture. Now, if we're talking right now and you're of the mindset that there's no way I'm going to get a reverse mortgage because I'm going to lose my house, I don't like Tom Selleck, I don't care about Pat Boone, all these nightmares that you have in your mind of what a reverse mortgage is, and that they're equity strippers, and no kind of a stripper is a good stripper. No kind of a stripper is a good stripper, especially an equity stripper. This is the video for you. So, all right, I'm sorry, I'm having some fun here. All right, so what we're going to do is we're going to flip this and we'll come back to this. But what we're going to do now is, through the power of technology, we're going to script and we're going to flip this. Now, if you watched my other video, if you saw the video that I did regarding the more likely it is for someone who has a traditional mortgage to be in a danger zone of going into foreclosure than someone who has a reverse mortgage, you're kind of familiar with this path and with these numbers and these boxes. And if you're new and haven't watched that video, I definitely would encourage you to watch it because I go more in detail. But for the purposes of making up your mind and arguing my case before the court, which is to argue before the favor of a reverse mortgage is better for you than a traditional mortgage, in my humble opinion, you're welcome to do whatever you want to do, and God bless you if you decide to stick with your traditional mortgage. Here's what I want you to do to prove me wrong and to help bolster your case so that you could make the argument to anybody else in the future if they come to bother you, is think of it this way. And this is the only way you can think of it. There's no other way. You have to look at every time you think about mortgage, and if you're going to keep your mortgage payment and be stubborn and say this is my path for the next 20 years, you have to look at your monthly income. Without the monthly income, you're going to get into trouble. That's land for foreclosure because you're going to have to tap into your reserves, and we're going to get to this box. So monthly income, what I do is I break it up so that you have the separation between husband and wife financially. And the reason you separate between the two spouses is that, God forbid, one of them goes into long-term care or they pass away. There's parts of their income that you're going to lose. Social Security between the two spouses is usually not the same. Now, granted, the higher paying spouse, when they pass away, the surviving spouse can petition and get the former spouse's higher Social Security, but they're not going to be able to double dip and get both Social Securities. Pensions are contractually obligated, and depending on how the pension was structured, for some people they may be a surviving benefit or not. So if you suddenly have a situation where you have a mortgage that can last 8 to 10 years from now, and you lose Social Security income and pension income, what does that do to you? That puts a severe financial strain to you, which I'm going to get to over here. For the other, I put other because there may be a situation if you have a commercial building or you have rental income or whatever the other is. This gives you your personal thing to fill out. So you have to consider and take into account monthly income. The reserves, well, reserves are key. Reserves were key on the flip side when we were talking about you qualifying for a mortgage, but they also matter here, especially if you decide to keep your mortgage and finish the race of paying off your mortgage. And here you need to know what your savings are, which I consider money in the bank, your investments, which depending on how you're structured, could be a 401 or could be an IRA. Now, the key takeaway here is that you have to look at if the money that you have on these accounts, the 401 or an IRA, are they pre-tax dollars that you've contributed to, or are they post-tax, like a Roth IRA or a Roth 401? And that's key because if you think about it in terms of if you invested a couple of $100,000 during the last 20, 30 years of your employment and you've built up a nice little chunk of 401 or IRA money and it's pre-taxed, at some point when you go to take that money out, okay, which is the case that if you have to have mandatory withdrawals, then you're going to have to be in a situation where you're going to pay taxes on them. And that tax and that withdrawal is going to be a consideration. It's going to be several considerations, and we're going to get to that. So here, I just want to structure it so that you understand what you're dealing with and the lay of the land. Well, we know you're going to have savings, what that is. We're going to know you're going to have investments. Is it pre-taxed or post-tax? Are you going to have stocks? Whatever it is. This is your chunk of money. This is your personal reserve that you're counting on. Okay. And I'm going to come back to the risks when we deal with this over here. So now we know that you have a mortgage in existence. So this is where the mortgage now is. Well, your monthly payment and interest, that's your mortgage payment. And what I want you to do, and the reason I broke this down, and I want you to do the same, which is easy to do, you get an amortization calculator, you put the original starting loan balance, the interest rate, and the monthly payments, and you could see over the period of the mortgage how much interest, how much payments are going towards principal. And this is what the breakdown is. So if I have, for example, I did a loan example where we said that the starting loan amount was $300,000 and the rate was 3.75, and I think the payment was $1,800 and change. It turned out that the majority of it, as always is interest, and then the balance was principal, and over the life of the loan, the person, if they kept the mortgage, would have paid $200,000 of interest on top of the principal. The reason this is important is because I want you to see that every year where you keep this mortgage, how much money is going towards interest and how much money is going towards reducing your principal. And the reason that this matters is that if you find out that you're paying $20,000, $30,000 in interest and you're on a fixed income and your CPA or tax advisor tells you that you don't have enough deductions to offset all of that interest, is it still prudent for you to pay all of your savings or reserves or monthly income to go towards this interest? And even more so, if you find out that at the end of the year you've reduced your principal minimally, does it make sense when you have paid down your mortgage a substantial amount and you already have a lot of housing equity, does it make sense for you to pay more money towards a reduction of the principal balance? Everything in this conversation, everything that we're talking about, if you are of the mindset that you want to keep a mortgage, has to do with the concept of, does it make sense for you to continue spending your fixed monthly income to pay off a mortgage? Does it make sense for you to deplete your reserves and your savings to pay down a mortgage? And with the ultimate idea and the ultimate end being that once you finish and you pay off the house, Now your house is paid off free and clear, but you have maybe $1 million home and you owe nothing on it. But if your reserves are gone and your monthly income is cut in half because of what we already talked about, what are you going to have to do? You're going to have to go to the bank and say, I either need a home equity line of credit, a HELOC, or I'm going to have to sell my property. And both of those options to me are very difficult options because you're 75, 80 years old, 85 years old. There's other considerations that come as a byproduct, and that's why this topic is so important that we really go into it. One consideration is that when you're 80 years old and your property is now fully paid off, when you go get a new loan or a home equity loan, we go back to this scenario that we were on the other side of the board, where the bank looks at and says, Mr. Jones, you have $1 million house, it's free and clear, your credit is excellent, you have an 800 FICO score, but you have minimal or no reserves. But the biggest problem for us is that you're not working and you're on a fixed income, and that fixed income, if we try to give you a $200,000 line of credit or a $200,000 mortgage, yes, your loan to value is only 20%, but you don't generate enough monthly income for us to be able to underwrite and be able to deal with your debt to income ratio. And that's what we were talking about in the morning video about debt to income ratio, DTI. So you have clients that have a paid off home or 20% loan, and there's a ton of equity in there and their credit is excellent, but because they're not generating enough income, the bank is not going to give them a loan. So if the bank is not going to give you a loan, then what's your other option? Well, your other option becomes potentially selling the property. Well, that has its own expenses. When you go to sell a property, right off the bat, you're looking at, let's say, 5% commission for the realtor. You're looking at closing expenses. You're looking at moving expenses. You're potentially looking at, if you've been in this property 20, 30, 40 years, capital gains of substantial home value wealth or home value appreciation. I have clients that I help that they bought their house for $40,000. It's amazing to think about it. They bought the house for $40,000 40 years ago, and we appraised the property for $1.3 million. Well, that huge difference is there's a capital gain aspect to how much money that has to come into. And when you get that, then there's tax consequences in terms of not only paying capital gains and income tax and all of that, but that may also have implications in terms of if you're getting some governmental programs that are financially needs-based, that you may not be able to qualify anymore because suddenly you have $300,000 sitting in a savings account. So there goes the argument that I'm destitute and I need money. So that's why it's so important to not just make the decision in a vacuum and say, I'm going to pay off my mortgage. There's a lot of other implications, and that's the intent of these videos, is really to inform you and make some suggestions for you that the next step is you need to go talk to a tax advisor, a financial advisor, an estate planning attorney, and have these things conversation. I'm just a messenger. I'm just saying to you that, look, this is around the corner. And if you're going to continue on this path, I would seriously consider looking at these other considerations that I'm just merely pointing out to based on what I see. I'm not giving you tax advice. I'm not giving you life advice. I'm not giving you real estate advice. I'm not giving you legal advice. God bless you and do whatever you want to do. But if you're going to do what you're going to do, get in touch with some of these people and make sure that you're on the right path. So once we take in consideration the monthly income and we break it down to how much of monthly payment for your mortgage, and we break it down to how much is interest and how much is principal, then the next consideration becomes, do you have an existing home equity line of credit? Sorry, I'm talking fast because I'm trying to put a lot of stuff in here. I got to slow down, go to my Zen spot. So if you have an existing home equity line of credit, either in addition to your existing mortgage or in place of it, well, again, you need to know how much that monthly payment is, what the balance owed is, and how much is interest and how much is principal. And we've talked about this where we said, if you have a home equity line of credit, the first 10 years, you're allowed to take interest-only payments and use the line of credit and make interest-only payments. But after the first 10 years, you're in this home stretch where you have 15 years, and in those 15 years, the line of credit is closed to you, and you're going to have to make principal and interest payments. Okay? So then, once we know what this is, we go to the box that we know everybody has to deal with, even if they don't have a mortgage on their home right now, which is your property taxes, and you divide that by 12, and that is one payment. Your home insurance, you divide that by 12. And if you live in a condo or a planned urban development or PUD or community where they charge a homeowners association, you put that in. So here, at a minimum, that we know that even if you don't have a mortgage, you're going to have to pay taxes, homeowners insurance, and homeowner association, most likely if you have a condo or a PUD. Then what I talked about before in that foreclosure video is that there are soft costs. Unless you're planning on living in a house that has no water, no lights, and looks like a jungle, you're going to have some soft costs. And those soft costs are the gardener, the pool, the internet, the gas, the DWP. So you're going to know what these are. Now, if you wanted to know what the reverse mortgage monthly obligation would look like for you, the answer is easy. Here it is. It's your two categories here, number 3 and 4. It's your soft costs, your property taxes, homeowner insurance, and homeowners association. Because why? You've backed out and we've paid off for you your HELOC and your first mortgage. And once we back this out and we pay this off, the benefit to you is that this money opens up immediately. So if you told me that my monthly payment on my mortgage is $2,000 and you don't have a HELOC, well, when I pay off the balance of your mortgage, let's say it's $150,000. When we pay off the $150,000 through a reverse mortgage, automatically you don't have a $2,000 required monthly payment anymore. If you choose to pay it, it's optional, but it's no longer required. So what do? Well, you take that $2,000 and you could apply it here. You could pay your taxes and you could pay your soft costs. Now, you could tell me, Benny, that look, my soft costs are $3,000 a month. Okay, I get it. But let me ask you this. If there were $3,000 and you had a $2,000 mortgage, you're used to paying $5,000. And last time I checked, $5,000 is a lot more, $2,000 more than the $3,000. So that means what? That means that either more of your monthly income or more of your reserves is having to kick in every month to cover this gap. Okay, and that's the key. Now, if you really want to do yourself justice and serve yourself the best amount of knowledge, what I would suggest is look at how much the balance is on your outstanding mortgage. In other words, if you tell me that I have another 10 years left before I pay off my mortgage, then what I will tell you is that there's a balance that if you wrote the check tomorrow, that's what one balance is. Then you find out that you have 10 years left. Then if you add up the total amount of interest that you're going to pay on top of your balance for the 10 years, this is a different number than what this is going to be if you pay it off, because you still have that 10-year period. And in that 10 years, you're going to have to pay principal and interest. So again, what happens is that this money that you have here, the total interest that you use to pay the next 10 years off, that's competing against what? Your monthly income and your reserves. Okay, and one of the things that I wrote here that I want to make sure that I point out to, that I always try to do, because a lot of people say to themselves, I have a line of credit and I'm counting on that and that's available right now so I don't have to worry about it. Well, if the bank decides to, not you decide to, if the bank chooses to close your line of credit or reduce your line of credit or freezes your line of credit, and you're counting on this money, which is at zero or some variation of it, and the bank sends you a letter and says, Dear Mr. and Mrs. Smith, we closed your line of credit because we're concerned about future home values, and unless and until you verify how much money you make and how much your reserves are, and we feel confident and comfortable sorry, your line of credit is closed. Now you're going to be in a kind of a pickle because you're not going to be able to use this line of credit the way you thought in case of an emergency. And that's why I said in the earlier video this morning, a lot of seniors that I'm talking to are running credit card balances that are revolving every month because they're using their credit cards as kind of a supplemental income to make up for some income that's lost here, or they don't have enough reserves here. And some of these credit card companies are charging 30%. My credit card company that I saw a statement of charges 30% for the revolving balance. And God forbid you're late one day, they charge you $40 on top of the 30% that they're charging you just to revolve this thing. So that's where the stress and anxiety comes in. That's where the risk of foreclosure comes in. That's what the situation is. Now, the reason I wanted to come back to this section here about the risks associated and to go back and finish this before we go to the other side is that if you tell me that I'm going to pay this off and I have 10 years in my example before I pay it off, and we know what the total interest and principal is in the 10 years, now you run into a situation where if your income is affected or reduced, you're going to have to supplement this payment, this obligation for the next 10 years at the cost of tapping into your savings, your investments, your stock, whatever your reserves are. Well, that has its own complications and that has its own implications. Why is that? Well, right off the bat, through the loss of a spouse or income, you're forced to tap into this. There's tax consequences, which is what we talked about already. Those tax consequences could be that by taking this money, if it's pre-tax, that could put you in a different income tax bracket. Or what it can do is that by having to take more money to supplement here, the money that is in the market, which has participation in the market and the growth of the market, you're going to take that money out. And that's that sequence of risk that everybody talks about. It's basically accessing your reserves to be able to use a portion of them in order to supplement your lost income. There's a whole host of things. There's required monthly distribution or required minimum distributions, that you may have to take money out. And if you need more money, not only to live on, but to pay off the mortgage, well, that may increase your RMDs, required minimum distribution, and that again can have tax implications. Again, this is the conversation to be having with your financial advisor, with your CPA, and playing this out and saying, look, this is what my goal is. I'm going to pay off my mortgage. Here's what my balance is. What does it look like for me? Is there a benefit to me paying, $25,000 of interest if I'm going to do this because I have to take this money out? And maybe your CPA says yes, and you're on the right path. I just want to sound the alarm so that you do something about it sooner and do it intelligently and do it with a decision where you're in charge of it proactively and it doesn't happen to you. So we talked about the market participation of leaving the money, and we talked about the fact that if you don't have to pay this entire thing off and the reverse mortgage pays it off, and as a result you don't have monthly payments, well, overall you're increasing your savings in terms of how long they can last. And that's where we get to when we come here and we now go back to the other side. And this is the big finale and the big push, because when I do this for my clients, and again, I'm sharing with you what my conversations are with my clients and this information, because it's no big secret. I'm not like trying to hide it from anybody. Even if you're not my client and I'll never meet you, God bless you. I hope this helps you. And if it helps you so that you can have a better retirement, I'm thrilled with that. So here is the takeaway, the aha moment for a lot of people. When you get a 30-year mortgage, which is what we talked about, we said typically people get the 30-year mortgage. You may get a 15-year fix if you want to really pay it off. But these 10-year, 7-year, 5-year, I don't mean that you got a loan and you paid it off in 10 years. What I mean is that it's amortized over 30 years. In other words, you have a 30-year glide path, but the interest rate was fixed for 10 years, 7 years, and 5 years. I did a lot of these back in the day, and that was because the person knew that they're only going to be in the house for a certain period of time, and the higher the interest rate, the longer the loan period. So if you get a 30-year fix, that's always going to be the highest rate compared to, like, for example, a 5-year fix, where the first 5 years the rate is fixed and then it turns into an adjustable. Now, go back in time with me and think about when you got your mortgage. When you got your first mortgage, the idea was you were working and being employed, you had income. And that income that you generated from work required you or produced a situation for you where you needed to have some sort of a tax relief. And the tax relief came through as a way of you getting a mortgage and taking the mortgage payment and taking your interest at the end of the year and offsetting it against your income. So what we used to do is that we used to get a loan amount, let's say for $300,000, and we say it was a 30-year mortgage, so that would bring you up to here. So this is a 30-year loan, this is year 1, 0, and this is your loan amount, right? So whatever your loan amount was, let's say it was $300,000, you got a 30-year fix, and then at the end of the 30 years, you were at 0. The other thing what happened was that you were considerably younger. I'm not calling you old, but I'm calling you the fact that when you first got your first mortgage was significantly younger. So, for example, you get someone, this is you with the bow tie, you got the loan when you were 30, and then you're 35, you're 40. By the time that you're 30 years up on the mortgage is up, you're around 55, 60 years old. So what would happen? The loan would be like this, right? This is the trajectory that you were supposed to get the loan, make small monthly payments, and at the end of the 30 years, you have 0. But in reality, what ended up happening for you and everybody else, and this is what I've done in another video that I've covered it in pretty detailed format, has to do with why no mortgage payments are required on a reverse mortgage. And if you think about it, is that every time home values came up, right, and interest rates came down, you refinanced the house because you were able to get a lower interest rate and take some of the money through the housing appreciation, and maybe for the same payment that you were paying before, you got a new loan with the same payment, but you managed to get $100,000 out of it, or $50,000. And with that $50,000, you paid off some student loans, you paid off a credit card, you bought a new car, you added a new island to the kitchen and remodeled the house. But this didn't just happen once. It kept happening over the last 30 years, bunch of times. And every time it did, what happened? Well, you extended and you started from 0, year 1, all over again. So what do we got? Well, we get into a situation where a person is 65 years old and they still have 15 or 20 years left on their mortgage. Well, what's the problem with that? Well, you were working here and you needed the interest deduction and you were generating monthly income, not from Social Security where you were trying to eke out $1,800 a month. You were making $100,000 a year and you had a substantial base of income and a substantial tax liability. So having this mortgage and paying all of this interest worked to your advantage. And the goal was that by the time I reach 60, 65, I'm going to have a house that's paid for. Here's their news flash. The baby boomers are coming into retirement with significant amount of debt, minimal amount of reserves and savings, and their houses are not paid for. And some of them have a mortgage where even if we try to do a reverse mortgage, we can't because there's just too much debt on it. If you remember when we flipped the script on the other side, I said that on a conventional mortgage can lend up to like 90% of the home value. So that means that if you take, we're going to get to this example, if you have a house that's worth $1 million and I lend up to 80% of that, which is $800,000, and home values depreciate 10 or 20 or 30% over the course of the next 5 years, you're back into 2008, 2009, where you have an inverse relationship. Your house and your loan amount are not where the house is here and the loan amount is here. You have a loan amount that's here and the house is here. You have negative amortization and you never got a reverse mortgage. You got a traditional mortgage where you're supposed to pay principal and interest, but because you borrowed up to 80%, 90% of the then value of the property and market went against you, you lost 10, 20, 30% of your home appreciation wealth, your housing wealth. Now you're upside down. So we have a situation where somebody could come to me, yeah, they're 70 years old, and you need to be 62 in order to get the reverse mortgage as far as eligibility of age. And we said that's one of the factors. We said age of the youngest borrowers has to be at least 62, or you have someone who's older than 62 and you kind of are grandfathered underneath them. In the example that we used, we said the husband is 68, his wife is 58. Well, when we do the reverse mortgage, we look at the fact that the wife, who's 58, can qualify because her husband is 68. So when you have a senior that comes to me that's 65, 70 years old, and they have 70% loan to value, there's not enough equity for me to do a reverse mortgage, which kind of gives away the story over here before I get to it about why your equity is not going to be depleted the way people have the misimpression and misinterpret the information. But we're going to get to this. But finishing up here, the idea was that when you were working and you're generating all this income, you're going to get a 30-year mortgage, and by the time you're 55, 60, 65, you're going to have a house that's free and clear. And from 60 till like 90, if you needed a situation where your reserves are gone and your monthly income is lower, you could then come and do a reverse mortgage. And this ties into the history of the reverse mortgage. The first reverse mortgage was actually given in 1961, but it wasn't until 1988 that FHA and HUD stepped in and Congress enacted it, and President Ronald Reagan then signed it. The first reverse mortgage was actually given in 1989. So the reverse mortgage is now 34 years old. So if you think about it, had you paid off your house so it's free and clear and you needed money and you're like 60, 65 years old and you're expecting to live till 90, which longevity now becomes a concern. And what is longevity? Longevity is I'm going to outlive my money. I'm going to be 80 years old and my savings is gone and my monthly income is not enough for me to sustain and carry all of my housing debt and pay off my HELOC and carry my soft expenses and my monthly expenses. That's what longevity is. And if you had paid off your house in this entire period that is potentially 25, 30 years old, 30 years long in retirement, you had the house that's free and clear, you were supposed to tap into the housing wealth. And that's why Congress enacted, and the President Reagan and every administration after that allowed for reverse mortgages to come in. It didn't, reverse mortgages weren't a bank invention. There were an intention and an act that housing wealth needed to be accessible by seniors. So if you think about this other aspect that I'm going to introduce now, I think you're going to get your aha moment. So when you bought your house back here, when you were making employment income and needed the tax deduction, and it was year number 1 and you're 30 years old, you bought the house, let's say, for, I don't know, let's say $200,000. I'm writing sideways, which is pretty generous for 30 years ago, because let's say it was. Well, this red line that I have here all along the way, what is that? That's your housing wealth, because over the course of the life of the loan and over the course of you getting older, your house has been appreciating, and that's this red line. So that's why when you finish over here, you get to 70, 80 years old, and you have all of this housing wealth. If you don't tap into it and you don't access a portion of it, that's when you run into a situation where you're gonna have potentially a foreclosure because you don't have the reserves and you don't have the money, or you basically run out of money and you're gonna have to tap into the housing wealth. So all along, your house was going forward and getting value and appreciation, and here you are, you're getting older, but now you're here and you may have $150,000, $200,000 left on your mortgage. But the good news is you're old enough to qualify for a reverse mortgage and you still have enough equity. So that is the perfect transition for us to say, what would it look like in terms of me getting a reverse mortgage if I want to get out of this hamster wheel that I'm on? Okay, and that's where we get to this section, the reverse mortgage. So we have two axes. The first axis has to do with the age. So I have it at 62, which is the starting age for an FHA. And then this brown section over here has to do with if your spouse is younger than you. Let's say this is, again, this example, the 68-58. If you're 62 and your wife is 55, well, we're going to put her on the loan. She's not going to be off the loan. She's going to be on the loan. And what we're going to do is we're going to make the determination of the loan based on your wife who's 55. The majority of people don't run in and get a mortgage that's a reverse mortgage at 62 with a younger wife that's 65. They usually have to really do a lot of soul searching and be in a financial kind of a strain. Or they have a really bright and, I want to say, educated financial advisor or estate planning attorney or CPA, some third party who's going to say, Bob, I don't see good things happening if you continue paying off the reverse, if you pay off your mortgage and don't get a reverse mortgage. And when they talk to someone like that, a neutral third party who tells them, it's inevitable, you have to get the reverse mortgage, then they start looking into it. But it's not usually at 62. So, but what I want you to see is the big picture, because God bless you, if you're 62 and you're doing it, I applaud you. You're a visionary, okay? In the, what do they say? In the land of the blind, the man with one eye is the prophet. You're the prophet. So we have the ages here. We have starting at age 62, and I have it going up to age 100. And the reason I go up to age 100 is not because I expect you to get a reverse mortgage at 95. I want you to see that this is our glide path. This is our ability to calculate and go forward. So these are the ages. Then what we have here are the loan to values. Remember in the first side, the other side, we talked about how you can borrow up to 80%, 90% loan to value. So in this scenario, let's say, for example, your property is worth $1 million, and $1 million now is not a big deal. You throw a stone and you're hitting a condo, it's $1 million. And you know, this could be a higher dollar amount for you, but I wanted to use the million because it's a nice, easy number to work with. So if you have a house that's worth $1 million, I start at 0 and I go up to 100%. And this is 10% loan to value, 20% loan to value. So what we know and what we've talked about in the, either I think the first video that I did, yeah, I think it was in the first video that I did in this series. When you're getting a reverse mortgage, we have 3 types of borrowers. Imagine these people as 3 neighbors next to each other. The first neighbor owns the house free and clear and is getting the reverse mortgage as a standby line of credit. The second neighbor owes $200,000 on the house and wants to pay it off so that they don't have a monthly payment. The third neighbor owes, let's say, $400,000, a higher amount. Now, these 3 people are going to be treated differently even if they're the same age, because their glide path is going to be different. And that's where this loan to value comes up. And this entire conversation, this entire thing that I'm talking about here now, has to do with the concept of the equity stripping. I'm worried about I'm going to have no inheritance. I'm going to have no money left. The bank is going to take my property. I'm going to lose my housing wealth. It's the doomsdayers scenario of the reverse mortgage is evil, and if I get it, I'm going to have nothing left. And the reason that doesn't work is because of the 2 or 3 factors we're going to talk about. We know what your home value is. We already established in this example it's $1 million. We know what your age of the borrower is going to be. Now, think about it in terms of, let me switch to this side so it's a little bit easier. And I'll move this over a little bit. There we go. Let's say you're 75 years old. If you're 75 years old and you owe 0, you're the first neighbor where you don't owe a balance on your house, and you get a standby line of credit, and you're not using the money because you're letting it be in place and increase over value, okay, you're not in a situation where you're eating a tremendous amount of equity because it's 0. Now, even if I put the cost of the loan, let's say between $15,000 to $25,000, and I know some of you are gasping, saying, oh my God, $25,000 for a loan? Absolutely not. This is another video that I'm going to do, and the cost of it has to do with the mortgage insurance premium. And the mortgage insurance premium is one of the factors here about why you're able to get this reverse mortgage and the features and benefits that comes with it, because the bank has to offset the risk that you're not working anymore and you don't have income and you don't have a substantial amount of savings and your debt to income ratio is not a consideration. In other words, all the things that go into the discussion of you not being able as a senior most likely to qualify for this mortgage are washed away and not a consideration when you get a reverse mortgage. Why? Well, because the federal government says, look, don't worry about the fact that Mr. and Mrs. Smith are not working and are not generating income. Don't worry about the fact that they don't have a substantial reserves, and don't take into account their debt to income ratio because their debts are going to be greater than their income. What we're counting on is that the lending guidelines are not going to be 80 to 90%. They're going to be 50% or less. And if there's 50% or less right off the bat, in other words, if I'm lending 50% or less, and this kind of brings it up nicely, if I give you starting at 0 with only a $25,000 starting balance on $1 million home, even if you don't make a monthly payment on this, how much money are you going to accrue on $25,000? It's going to be a couple of $100, $200, $300. Okay, $300 compared to $1 million home value is a tremendous amount. You're not stripping the equity away. So the government, the federal government who insures, that's what the non-recourse aspect of the loan is. A reverse mortgage is a non-recourse loan. Well, what does that mean? Well, that means that even in the scenario where in 2008, 2009, when we talked about mortgages being upside down, your balance was higher than the home value, people who had reverse mortgages and passed away, because you don't control when you pass away, you might pass away during a recession. You might pass away when interest rates are at 8%. You might pass away when home values have depreciated 30%. And God forbid, whenever you pass away, we don't control the outside universe that happens in. And if it falls into place where you've lost a significant amount of equity, which is home equity wealth appreciation through property values, and you're upside down, the federal government says, listen, when you got this mortgage, you bought insurance, and that's the private mortgage insurance. And along with that insurance came a lot of features and benefits. And one of those features and benefits was that you don't have to make a monthly payment, because we're going to let you use a portion of your equity so that you don't have to make a monthly payment. Another feature and benefit was that if the properties go upside down, you can walk away. Your estate is not obligated. Your heirs are not obligated. And that's a big feature if you think about it, because I know a lot of people don't think this is the case, but in a traditional forward mortgage, in this scenario here, if God forbid you pass away and properties are upside down like they were in 2008, It's not like because a person passes away, their debts go away. The bank could come after the estate and say to them, when the deceased passed, he owed us money. And when we sold the property, we didn't get compensated, and we need to be made whole. And then if there's enough money in the state, the bank can come after the state. There's different scenarios, I understand it, but I don't want to get into the weeds and get too confusing. But I'm just painting so that you understand when somebody says, I paid $25,000 to get a reverse mortgage, you don't fall back on your chair. They're talking about the features and benefits of a private mortgage insurance and the closing costs, which everybody pays: escrow, title insurance, and lender fees. That's another video coming. Sit by. But the reason that you can get the reverse mortgage is because of the private mortgage insurance. The reason you don't have to make a monthly payment is that when the bank gives you a reverse mortgage, you're not starting at 80%, 90% like you are in a traditional mortgage when you were working. Because what was happening when you were working and you were making all this money and you were in a position to keep paying off, what did the bank count on? The bank counted on the fact that you have income employment, you have reserves, and your debt to income is acceptable. And you're only 40 years old. You've got 30 years to work. We got nothing to worry about. On a probability list on a life insurance actuarial table, someone who's 70 is more likely to pass away than somebody who's 40. And that's what the bank counts on. The bank counts on the fact that if we give you up to 80 or 90%, because you're working, it doesn't matter. And you have so much reserves and you have so much other things going on. Your debt to ratio is okay. You have a co-borrower. You've got all these things going. So we'll push it to the limit. We'll give you 80, 90%. But even that's now not really the case anymore. It's typically 80% or less. But the reason I'm getting to this detail is so that I want you to understand a forward mortgage is really the flip side of a reverse mortgage. The reverse mortgage was supposed to start here and finish out the race till you reach 85, 90 years old and use your home equity to get to the end and have the flexibility. So when you're starting at 75 and you owe zero and your cost of the mortgage is $20,000 to $25,000, you may not use this money right away. Now you say, if I don't use it, why the hell am I getting it? Well, you're getting it because once you get the reverse mortgage, your property value is locked in. So if today I know my property value is $1 million, but 3 years from now it's going to drop to $700,000, I don't have to worry about the bank sending me the letter saying that, Mr. Smith, your HELOC is closed. And we're sorry, but we can't open it up for you. So by locking it in, you're taking a freeze frame of the value of the property today. So even though you don't use this, what's going to happen? The money that you have available in your line of credit, let's say I give you a $300,000 line of credit. Okay, and you don't use it for this period. When you get to 5 years later, it's not going to be $300,000 anymore. It's going to be substantially higher depending on the interest rate. Like right now, I'll give you an interest rate of 6%. Well, if you take 6% at $300,000 and you compound it month after month after month, which is the opposite thing of what happens with reverse mortgages and why everybody freaks out, because when I'm not making a monthly payment, my monthly balance grows. But then the flip side of that, which nobody tells you and nobody seems to concentrate on, is that if I have a line of credit and I don't use my line of credit, so I don't have to make a payment on the line of credit, that line of credit is also growing month after month after month. So let's say my $300,000 5 years from now becomes $400,000. That's now an extra $100,000 that I have to use when I need it, when my savings go down, or if the market investments are going against me and it's not a good situation, and I can benefit from doing something else with the money. There's a whole other host of conversations. What I'm getting at with these videos is that you can't be linear. You can't just look at one thing from the perspective that you're looking at and not look behind it, not look on top of it, not look underneath it, not look to the side. You have to have a 360. You have to be able to approach, like the way I think of it, the way I help my clients is that I approach every topic as it relates to the product, as it relates to the senior and their retirement and their objective and their goals and their financial advisor's goal from every possible angle so that they have a 360 view. And unless and until you do that, you limit or you reduce your path for success. And that's why I'm taking so much time and energy to really go into the weeds here, because when this video is done and it's out there, I hope people watch it. This is what I send to my clients and say, look, if you're thinking about this, here's the way I look at it. And I hope this helps you. So here what we have, we got a little messy here, so I'm going to clean this up and then I could make my original point. You're like, please, for God's sake, make your original point already. We're falling asleep. We need some coffee. All right, so look, you're 75 years old. I pay off your mortgage with a balance of $200,000 on your house that's worth $1 million. Right off the bat, in our example we've been using, you are now not obligated to pay on the $200,000, you're not obligated to pay $2,000 a month mortgage payment anymore. And that's money that's freed up to do other things. That's the given. That's an easy. That's even Stevie Wonder could figure that one out and see through. So this $200,000, and the key point about negative amortization and understanding equity and equity stripping and equity depreciation, all jokes aside, is that when you have $200,000 balance and you're 75 years old, the question becomes, how long are you going to live in this house? How healthy are you? How plausible is it for you to live in this house for the next 20 years? Are you in a position where you can maintain and keep everything in terms of comfort and safety? If you need to have someone around because it's a 2-story house and you can't go upstairs, if you need something where 10 years from now, okay, you're okay for the next 10 years going up the stairs, you're okay and you're independent, you could walk into the tub, you got everything else. But God forbid, 10 years from now, things become difficult, you're not going to be able to stay here for the next 10 years after. And that's where the conversation becomes, if you look at how reverse mortgages work, they go like this. You don't get $200,000 and tomorrow your balance shoots up. What happens and what's likely, let me use a different color so you could kind of maybe see it a little bit better. Here, I'll use this. When you get the $200,000, the growth factor of the money, the negative compounding, is like this. It's gradual. And if you look at it, if we say that you're only in the house for 10 years, this cuts it so that how much amount of negative amortization could you have accumulated over the life of the 10 years that you're in the house at the balance that you're running in. And that's why I said it's important for you to figure out which one of the 3 neighbors you are. Are you at 0? Are you at $200,000, which is the equivalent of 20%? Are you at a higher percentage, which is, let's say, maybe 40%, 50%? In other words, not all borrowers are the same because each borrower's needs is different. And their need is going to determine a different amount of negative increase in property depreciation of home wealth. And that's the key. So now I hope you kind of see a bigger global picture of what I'm trying to share with you, which is to tie it back to where we started. It's not just about what the loan amounts are. Yes, anybody could tell you how much money you're going to get with a reverse mortgage based on age appraisal value and interest rate, and anybody can give you what the loan amounts are going to be in terms of a forward mortgage once they figure it out, your debt to income ratio, your monthly income, run your credit score. That's the obvious, and that's just formulaic. You got to go into the weeds. You got to go deep. You got to figure out that you're in this stretch over here. You're not here anymore where it was the first 30 years you got the mortgage and you were generating a lot of income. You're in this second half here where you still have a monthly income, where your income is at risk because of loss of a spouse, loss of income, where your savings are going to be depleted if you decide that you're hell-bent on paying off the rest of your mortgage, and you'll have a home equity loan, and these things are affected. And their effect is going to have a dire consequence on the quality of your retirement and everything else. And the reverse mortgage comes in and says, remember you were supposed to pay this house off, and once you did, it was supposed to help you? Well, this is the portion of the program where the help comes in. By getting it and having to only pay property taxes, homeowners insurance, and your soft costs, you're preserving your financial independence. You're not living hand to mouth. You're not in a strain where you're paying all of this. And I'm going to do a video that talks about inheritance from both the perspective of the parents who are thinking that they want to leave something for the kids, as well as their kids who are thinking they're entitled to have the parents leave them something. And I chuckle because that's actually true. I sit down with kids who, right in front of me, tell the parents, but what happens to my inheritance when you decide to get a reverse mortgage? I'm not going to have anything. And, when I say kids, you think of like 12, 13-year-olds. But, if you're 75, 80 years old, you don't have a 12 or 13-year-old. So you have someone that is now thinking that your retirement should fund their lifestyle. That's my little personal commentary. I'm sorry, but that's a hot topic for me and I have a very strong opinion on that. But we'll leave that fight for another day. All right. I hope you took a break and put this on pause and went and got a cup of coffee and made it to the finish line. If you can't tell, I'm very passionate. I'm very passionate about reverse mortgages, and when somebody comes after a reverse mortgage, I have to hold back because, and look, let me just get serious for a second. The reason I have to get serious about it is because seniors are suffering. When we're talking about 30% interest rates on a credit card, and you have a $6,000 revolving debt running $180, $200 a month, and you're on a fixed income, and you've got this incredible housing wealth, you're sitting on $600,000, $700,000, and you're struggling, and you can't see through the fact that this money is supposed to help you and be yours, and you're trying to pay off more of an inheritance for somebody else to come in to get the house. And people that are your age or older who've passed away. How many of the kids are living in the parents' home? Let me just ask you that. We're adults, let's talk about it, and let's deal with the elephant in the room. How many people do you know that are your age or older who, when they passed away, it didn't turn into other than a fight and a money grab for the kids for the week to follow, to put the house up for sale, sell the house, divide the money. Somebody goes and buys a Cadillac Suburban, the other one remodels the house, the third one takes a vacation, and the money's gone. And that was the money that you spent every month not having a good quality of retirement so that everybody else can get a money grab except you. I'm sorry, God forbid that this is the case in your personal family, but this is what I see. And this is why I'm so passionate. If whatever is left after you get it, after you spend it, after your quality of life and financial independence is secure, fantastic. Let them have it. But not at the cost of you not being financially independent, not having dignity, not having financial freedom, and everything else that goes with it. I'll apologize because I know I'm getting on my soapbox and I'm getting angry and I don't want to. So let's finish on a good note. I tried to cover everything soup to nuts on this video and bring it all together to really make a relevant and informative video. I hope you found it informational. I want you to contact and connect with your financial advisor, your CPA, your estate planning attorney, to talk about and discuss the concerns that I have. This is not me giving you advice. This is me telling you this is what I see happening, and this is my education telling me this is what's happening. In your particular case, do your own homework, do your own due diligence, contact these professionals, show them this video. Maybe that's the best thing to do. Show them, say, listen, I came across this guy, Benny Victory, and I saw this and he was ranting and raving like a lunatic, but he brought up some points that I'm concerned about. Can you do me a favor and watch this and tell me what I have to worry about? And he'll love it because he'll say, oh my God, this is an opportunity for me to help these people out and get some new business out of it. And worst case scenario, he'll be glad that you're thinking of him and that there's a potentiality of doing something with you. So either way, it's a win-win. All right, I need to wrap this up and go lunch. Thank you for being my client. Thank you for listening to me, and I hope this information is relevant to you and helpful to you. My ultimate desire and goal is to see you have a quality of retirement, a quality of financial independence and dignity, so that you're not uncomfortable and you're not straining. Thank you for being my client, my potential client. See you tomorrow, and God bless you. Have a good day.